Hello, my name is Stephen Pinhey and I work for an organisation called the Association of Taxation Technicians as a technical officer, and I'm going to look at different types of working. We need to earn money in order to pay for anything we buy, for example products, gadgets and social experiences. This money or income can be earned in a number of different types of ways. So let's have a look at some of them. By far the most popular way to earn money is as an employee. At present, there are nearly 33 million people employed in the UK. Employees pay tax via a system called Pay As You Earn, or PAYE, and it is designed to do exactly what it says on the tin. Every time an employer makes a payment to its employee, it deducts a proportion as income tax, together with national insurance contributions. This amount is then paid across to His Majesty's Revenue and Customs, better known as HMRC. For most employees, the amount of tax and national insurance contributions that the employer deducts and pays over to HMRC means that there is nothing further for them to do, and they have little, if any, interaction with HMRC. For some who are high earners or whose tax affairs are more complex, they may have to complete a self-assessment tax return each year, which will include their employment details, together with any other income, gains, deductions or reliefs that that person wishes to declare or claim. For example, any interest received from savings accounts or any work expenses you want to claim. The second form is a self-employed worker. A person is self-employed if they run their own business and take responsibility for its success and failure. Self-employed workers are not paid through PAYE, and they do not have the rights and responsibilities of an employee. Self-employed people pay their taxes differently from employees. The tax is calculated on a percentage of the profits of their self-employed business. So they need to complete accounts to work out how much profit they've made. So what are accounts and what is profit? Accounts or financial statements usually comprise of a profit and loss account and a balance sheet. A profit and loss account is a summary of a period, usually a year, of the income or sales that the business has made, less all of the expenses that have been incurred to make the income or sales. These expenses could be materials, wages to employees, factory or building costs, and a whole host of other expenses related to running the business. The income minus the expenses leaves you with the profit. This profit can be written down as a sum. Income or sales minus expenses equals profit. A balance sheet shows what a business owns and what is owed. For example, a business may own buildings, vans, bank accounts, etc., called its assets, and owe money to suppliers and other people, called its liabilities, and it is balanced by the business owner's monies. A balance sheet will always balance and can be written down as owns minus owes equals business owner's money. In jargon, this is expressed as assets minus liabilities equals equity. The tax that is calculated on the profits of the business is notified to HM Revenue and Customs, the government body responsible for collecting the tax, on a self-assessment tax return which needs to be completed each year by the 31st of January. The amount of tax due on the self-assessment tax return is paid over to HMRC, usually in 2 instalments, on the 31st of January and the 31st of July. Where a group of 2 or more people, we call them partners, come together and carry on a business, we call this a partnership. The partners are responsible for running the business and they share the profits between themselves. Except in certain partnerships, partners are normally personally responsible for paying their bills on their proportion of their partnership profits. They pay these in a similar way to self-employed people by completing a self-assessment tax return and paying the tax usually in 2 instalments, 31st of January and 31st of July. The final way of working and earning money that we are going to look at is as a company director. A company director is responsible for the running of a company. The company director may also own all or part of the company, but this is not always the case. And in large companies, the company will be owned by lots of different people or even other companies. Although company directors have a very responsible role in the company, they are essentially another form of employee. So they will be treated similar to an employee, and their salary is paid via the PAYE system.